Hello, everybody. This is Divestments coming to you with another short video. As always, my videos are for educational purposes only. This is not investment advice. So this is going to be a review of our June 29th class. First thing I want to we talked about the characteristics of a good stock. We want to make sure that our stock is over $25. It trades over 1 million shares or more per day. It has options available, and our ATR is at least $1 or higher. What makes the market or a stock move? News. Simple as that, news. It could be good news. It could be bad news. It could be talking about earnings. It could be dividends. It could be management changes. Any type of news. It could be a new product. Any type of news makes the market or a stock move. The Dow 30 or the Dow Jones Industrial Average is the top 30 U.S. stocks. The New York Stock Exchange, if a stock is listed on the New York Stock Exchange, it will have 1 to 3 letters as its symbol to represent that particular stock. If it's listed on the NASDAQ exchange, it will have 4 or more letters to represent that stock. No two stocks will have the same symbol to represent it. Okay. It's like your fingerprint. Okay. Your fingerprint is going to be different from somebody else's. So each stock has its own identity and its own symbol. S&P 500 is the top 500 U.S. stocks. Your homework was to start your watch list by picking 5 stocks, and we'll review those on the next class. There are different types of traders. You have a day trader, you have a swing trader, intermediate, and position. Each trader is going to hold an option for a different amount of time, depending on what type of trader you are. Okay. If you're in a stock for the long haul, you may be a position trader because you could be in that trade for weeks, months, even a year. We call those type of options leaps. If we're going to trade a leap if we're going to be in it a year. Characteristic of a good option. Okay, you want to be at least 2 weeks out. This will change depending on the type of trader that you are. Like I said before, if you are going to be a position trader, you wouldn't pick an option that is 2 weeks out. You would pick a option that may be 6 months to a year out. The delta is always going to be a 0.25 or higher. No need to go with a higher delta than a 1.0. Your open interest is going to be at least 100. You need people to trade with. If you don't have anybody to trade with, then you will be able to get into a position, but you won't be able to get out because you don't have anybody to trade with. So make sure you have at least 100 open interest or more. Options with high daily volume shows that people are buying that option at that strike price on that day. Option volume is volume for the day. Open interest is previous volume. Buy time because options will decay as they get closer to the expiration date. So let's look at some examples using our delta. So QQQ is currently trading at $300 a share. If we wanted to purchase 100 shares of that stock, it would cost us $30,000. Instead, we're going to buy an option, which is cheaper. And that's one of the reasons why we trade options, is because it's cheaper. We can control the same amount of shares for less money. So we're going to buy a $310 strike price call option, okay, with a premium or ask price of $1.50, which is only $150. So would you rather spend $30,000 or $150? Okay. This contract will expire in 30 days. Okay. So our stock price starts out at $300. We have a delta of a 0.25, and our option price is $150. Our stock price went up to $301. Our option price went up $1 to $1.75. It went up 25 cents. Our stock moved another dollar and it went to 302. Our option price went to $2. Our stock price went to 302.50 and our option price only went to 213. The price of the stock only moved 50 cents on that last one. So that means that our option only moved 13 cents. Okay, half of a delta. So half of a delta is $12.50. I just rounded that up to 13 cents. So that's what our option moved, 13 cents. So our ending price of our option is $2.13. So it went from $1.50 up to $2.13 with a $2.50 move on the price of the stock. Our next example, QQQ is currently trading at $300. Again, if we wanted to buy 100 shares of that stock, it would cost us $30,000. Instead, we're going to buy one contract, a $310 strike price, because call options are, we are hedging that the stock will go up. So we're expecting our stock to get some to $310. And our option price or premium or the ask is $225. So because our delta is higher, our option price is going to be higher. This contract also expires in 30 days. So in the last example, we paid $150 for our option. In this example, we're going to pay $225 for our option. Our stock price is at $300. Our delta is at 50 cents. And our option started out at $2.25. Our stock moved $1. Our option moved 50 cents, and it went up to $2.75. Or it moved $50. Our stock moved another dollar and went to 302. Our option price went to 325. Our stock price moved 50 cents and it went to 302.50. And our stock went to, our option price went to 350. So in this example, the stock only moved 50 cents and the option only moved 20 cents or 25 cents or half a delta. All right. So study on that, get that clear in your mind, and I will see you on the next class.